Tony asks on registration, what re the rules for the sale of an investment property regarding CGT after age 56 if sold in a self-managed super fund? I think the question Tony is asking here, if he owns an investment property within his self-managed super fund and he's 56 years of age currently, what's the tax implications of selling that property? Well, the benefit of holding it within your super fund is that if there's a capital gain, if you bought it for $400,000, it's now worth $500,000, that $100,000 gain that you made should actually be tax-free, or you should be able to manage it so that it's tax-free. If it's currently in the accumulation phase, the earnings on that investment would be taxed, or within your superannuation fund, if there are positive earnings, would be taxed at 15%. So in superannuation, the accumulation phase, 15% on earnings, 10% on capital gains. But what you should be able to do, if you have reached the preservation age, is move that asset, and there are some other requirements that you need to consider, but you should be able to move that asset into a pension phase account. So an account that's in pension phase, and then if you sold the asset when it's in pension phase, there's no capital gains tax to be paid. So you should be able to sell it tax-free if that's the good news, if that's your particular scenario. But you need to factor in a couple of important implications, and that's whether you own the asset, for example, jointly with your spouse. So you're part of the member balance is for a spouse that's younger than 56. You've got to be wary of those kind of issues as well. So just factor that in too.